Hello, I'm Edison Byzyka, Chief Investment Officer at Credent Wealth Management. In lieu of a written weekly market commentary this week, I'm providing this video commentary to further shed some light on recent events. The volatility across global equity markets that commenced in late February 2020 has been one of historic proportions. The S&P 500 plunged over 20% in the fastest pace on record over fears associated with COVID-19, the novel coronavirus, and sent the index into bear market territory. There is absolutely no hiding the fact that such downside in such a short time frame can be shocking, even for professionals in the industry. That fear factor is likely to be exacerbated over the coming months as talks of a recession may likely amplify. After all, COVID-19 pinpointed tremendous supply chain issues following China's efforts to quarantine the virus, and we're now seeing the potential for demand-side issues as consumers feel the need to avoid malls, car dealerships, and even grocery stores in certain parts of the country. Such a double whammy on both supply and demand can often result in economic weakness. If I had to stare into my crystal ball, I'd likely venture that a recession is inevitable at this point. Just don't ask me when. Attempting to correctly time macroeconomic events is by far the most futile process that exists. Just ask the 400 PhD economists at the Federal Reserve. I did say 400. The fact remains that recessions are part of the normal business cycle, and they're often necessary prior to the beginning of a new and often stronger economic growth cycle. It's really that simple, despite our human nature to produce unwarranted panic at the idea. Our human nature further takes hold when we dig deep into our recency bias, where we often associate upcoming recessions with the immense fright of the previous one in 2008, which unfortunately did prove to be the worst since the Great Depression. As we gauge the current environment, however, and as the previous recession's wounds are once again coming alive, I want to provide a sense of objectivity amidst the current chaos. Firstly, we want us to recognize that the equity market and the economy are different animals that tend to react differently on the same set of news. It's possible that equity markets are pricing in the weaker economic data points of the future. This may imply a scenario where equity markets remain neutral or may even gain value during an actual recession. If that sounds crazy, it's not, because it's happened numerous times in the past. Secondly, it's hard to justify the fact that a bear market in itself can cause a recession. That's simply not true. What we're witnessing with COVID-19 is a level of uncertainty that cannot be currently quantified by market participants, despite media efforts. The best sense of weakness will become evident in the upcoming earnings season in 3 weeks, when we receive forward guidance from major U.S. companies on their earnings potentials. Thirdly, let's not forget the fact that prior to the COVID-19 equity market panic, the backdrop of the U.S. consumer remained in extremely healthy territory, unlike recessions of the past. The number of people voluntarily quitting their jobs nearly peaked prior to the market panic, retail-based sentiment had not faltered, and net new monthly private payrolls surged. Additionally, household debt as a percentage of disposable income remained at record lows. Wage growth established a promising uptrend, home buying sentiment conditions improved, and investors remained bullish on the overall stance of the equity market. Such data is critical when gauging the potential severity of the next business cycle shift. In my view, this means that the impact of the next recession has no roots embedded in fundamental economic issues like those in the 2008 credit crisis. There's also lack of concrete evidence rooted in equity market bubbles, such as the outstretched technology sector valuations we saw in the dot-com bubble of the early 2000s. As a result, the current record pace into bear market territory may have provided a gift for those investors with a 5-year or longer investment horizon. Readjusting the risk level of existing exposure, or even liquidating bonds to buy stocks, may all be things that an investor should seriously consider, and are all things we are actively doing on behalf of our clients. Always remember, there is never a clear roadmap tied to equity market volatility, and nothing will signify the definitive bottom of the market. After all, the goal is to acquire equity exposure on sale. It's not to time the market. Thank you.